Marco Valli is the Chief Eurozone economist at UniCredit Global Research, and he joins me now from Milan. Thank you so much for joining us. Let's start with the good news for Italy today. Italian business confidence rose. But is it the case that manufacturers are really becoming more optimistic about demand for their goods? And if so, where does that optimism come from?
I would tend to take the August data with a pinch of salt. August numbers are usually subject to a high degree of volatility, in part due to the particularly time in which the collection takes place, and also because of seasonal adjustment problems. So I definitely do not think that this is the beginning of a rising trend in confidence. In contrast, I do think that we will see some payback, possibly heavy payback in September, and a downtrend continuing also throughout the fourth quarter of the year. So I really warn that this number should be seen with some degree of caution, and do not extrapolate trends that seem too optimistic to be true.
Okay, maybe people are just in a good mood in August because they're about to go on holiday. Tell me, what about the bond auction in Italy today? How do you think that went?
It went decently well. In a sense, we have seen yields coming down quite substantially, 50 basis points less and almost on a 10-year, and almost 100 basis points less on the 3-year, which is actually quite good. However, we have to say that demand was good, but not particularly strong. So this, to me, it's telling you one very important thing, that for the time being, Italy really needs ECB support in the market in order to avoid a further spread widening. And this is something that is important to bear in mind.
Indeed. Now, let's move on to look at what's happening in the Eurozone. Sentiment there, consumer sentiment dropped, and that was more than expected. In fact, I think it's the biggest one-month decline since the Lehman Brothers collapse. How big a blow is this when the Eurozone is looking desperately for growth?
I think this is quite a poor data, but unfortunately it was also quite expected. We had seen business sentiment coming down sharply in Germany, in Belgium, in Italy today we got a surprise, but again I think this is not going to last. So this was quite expected, and I think this paves the way for a pretty poor third quarter of the year in terms of GDP performance. We are looking for GDP growth of around 0.1% in the third quarter, and we think a further loss of momentum is in the cards for the fourth quarter, when the recovery will probably come to a complete halt, with risks possibly tilted to the downside. Obviously this does not come at the right time, because the whole world is slowing down at this stage, and fiscal consolidation, particularly in Italy, is going to kick in the very short term. So this definitely comes at the wrong time. However, we also have to keep in mind that if we take a look at the core Eurozone, fundamentals, particularly at the corporate sector level, are still quite okay. So I tend to rule out the possibility that the Eurozone will slip back into outright recession, and any negative growth surprises in the near term will probably be offset by some moderate recovery in growth momentum next year. Although obviously risks to this scenario are tilted to the downside.
Now, with the austerity measures coming in and a lack of growth, is it possible that a rate cut is once again becoming an option?
I don't think so, at least in the near term. Interest rates are already quite negative in the Eurozone, and the ECB, yesterday we had the Trichet speaking before the European Parliament, is still sticking to the fact, to the assessment that growth is slowing, but it's not stalling, and Trichet never mentioned the risk of recession. So the way I see it is that the ECB, also in the September staff forecast, will stick to the moderate growth story, and this should rule out a rate cut in the near term. I tend to think that rate cuts will become a feasible option only if we do see outright recessionary environment, which we do not expect, and not in the very near term, because I tend to think that the ECB will want to see actually weakness materializing in hard data, not only in business surveys, before easing monetary policy. Let's not forget that we already start from ultra low interest rate. One thing is to say that the ECB has to ease when interest rates are at 4%. Another thing is to say that the ECB has to ease when interest rates are at 1.5%.
Okay.
I prefer thinking that the ECB will prefer to rely on unconventional measures rather than cutting interest rates outright.
Okay, Marco Valli, we'll have to leave it there. Thank you very much indeed.